Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hi, I'm Ravi Singh, Chief Investment Strategist at Standard Chartered Bank India. Welcome to another edition of Views from the Street, bringing you market views and insights on how you should look at your investments from industry veterans and experts. Today, we are joined by Mr. Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life Asset Management Company. Welcome, Mahesh, to our podcast.
Yeah, hi, Ravi. My pleasure. Okay.
So, Mahesh, let's get to the first question straight away. 2023 has been a year of transition, some for known reasons and some for unknown reasons. What is the macroeconomic outlook for 2023?
Yeah. So, last year, we've seen a reasonably strong growth, from a lot of companies reported very strong growth last calendar year because global economy was doing well. Indian economy is also coming back from the COVID period. And as a result, we saw high inflation really starting to percolate and the central bank started to increase interest rates. So as we step into this calendar year, we are seeing that the interest rate increases which have been done by the central bank domestically as well as globally, that is starting to hurt a bit in terms of the growth outlook. Inflation, which is now starting to come down. The good news is that inflation is starting to come down, but it's still coming at a slower pace. In US, for example, the labor market is still, as a result, the increasing interest rates, what we're looking at, while we are nearing the fag end of that, but it looks like the interest rates will remain higher for a longer period of time than what we had anticipated earlier. And that would probably have some longer term impact in terms of the growth. Though I would say the underlying growth is still fairly strong, even in the US. And globally also, if you look at the IMF has actually increased the growth outlook for this year marginally because even China, for example, has been coming back after lockdown and we see a very strong growth this year. So I think clearly for our basic perspective, if you look at macroeconomic outlook, after the budget, the focus was more on driving investments and capex. And that's where the focus has been, which is good from a long-term sustainable growth perspective, though it doesn't really help much to stimulate the economy because to drive consumption in the shorter term. So we are expecting economic growth, GDP growth this year to be around 5.75 or so, slightly lower than what the government is expecting, around 6.2. But I think the foundation of India's long-term growth is very much in place. That's the good thing because all the reforms what we've seen over the years and also the fact that the way global geopolitics are changing, the way the global MNCs are looking at diversifying the supply chain, and India is very well positioned for that. The way India has adopted digital in a big way, I think that paves the foundation for a more long-term structural growth for India for the next decade or so. So while this year you would see some kind of a slowdown, there are pockets like, for example, in the consumer discretionary side, consumer durable has seen some slowdown. The rural economy is still coming back, but is still struggling a bit. It requires some support, from the government. Which probably you will see the latter part of this next fiscal year because as we move into the elections next year, you will see more spent by the government. So all I'm going to say that the outlook for India still remains fairly decent. Consumption is still slowly coming back. Investments are picking up, while exports will be lower because of the global slowdown. But I think we are on a path of steady recovery. And I think even on the inflation side also, we have seen inflation coming down, though recently the food inflation was higher. We expect the policy rates to remain another 25 basis from here, but after that there will be a pause. And on the global front also, I think the consensus now or the expectation is that you will see a more soft landing rather than US economy getting into a deeper recession. And to that extent, I think the markets have also kind of cheered that a bit and we've seen rebound across global equities. So it's a period where definitely growth is going to slow down. You will see earnings growth also getting impacted and there could be some downgrades to earnings. Though in India, we would not see a large downgrade because a lot of sectors are still participating and especially large sectors like banking is likely to show a good improvement in margin on the back of increasing in the net interest margins and lower NPAs. So slightly cautious, but I think India long-term story looks fairly intact.
That was quite comprehensive. Now, let me tie in a question to you on this. You did mention some challenges faced by certain sectors and some sectors which are likely to do good. But if you were to summarize your views on, the relative attractiveness of equity versus bonds, given that bond yields have come up and at a decent, attractive, absolute levels. How do you see equities versus bonds, and whether there are specific areas of opportunities that you see within equities?
Yeah. So you're right. I think this year is going to be a period of slight consolidation in equity, because we are seeing that because of now higher interest rates and overall liquidity getting much more tighter, the easy money is not there. So valuations, will probably normalize. So we had seen last 1 year, the multiples had moved up. Even the market Nifty P multiple would have been above the long-term average. We see that normalizing this year to the long-term average. And while earnings growth will be fairly decent, we expect earnings growth to be around 12 to 15% in that range. But market returns would probably be in the high single digits. And in that context, if you look at bonds or if you look at the fixed income space, now with interest rates going up, it is also offering a very competitive return on a risk-adjusted basis if you take a 1 year view. So I think in fact, we are saying that this is a year we will see return across asset classes, be it equity, be it debt, even for that, would be in a very kind of a narrow range. We're not seeing any extraordinary returns anywhere. So it's a good to be diversify across asset classes and try to really reduce your overall volatility. I think that would be a good strategy. On debt, I think the shorter end of the curve is offering fairly attractive rates at this point in time. And I think 1, 2, and 3 year buckets are offering very good yield, and an accrual strategy would be a good strategy really to play out and do that. Apart from that, I think, but if you're looking for a really long term beyond, 1 year or 3 years or more, then equities we think will still offer a reasonably good upside, because we are seeing in a phase where India's overall growth is probably going to be around 6.5% or so in that region over the medium term. And corporate earnings growth have been actually coming out from a very low period of slow growth since 2015, and we're seeing that at least being in double-digit kind of growth. So long-term equity returns can still be in the low teens, which is a good risk premium, for what equities would require over bonds. So from a short-term perspective, I would say that debt should be also considered a part of an asset allocation. Looks fairly attractive. And long-term, I think equities would still offer a good upside. And within equities, I think the pockets really where one would like to play that will be more or domestic centering, right? Because I think India is where I think the growth would be much stronger and much more sustainable. So we would like to play that through sectors like, say, banking and financials, which looks good. Manufacturing India is also now coming up good. I think we have seen the government focus on domestic manufacturing. Also, a lot of global MNCs are looking to make India as a manufacturing or as a sourcing hub, which will drive growth, be it in, say, specialty chemicals, what we have seen, be it in auto ancillary space. So that's another area of growth, where we are seeing. And even digital, if you look at, right, whole theme, what the whole world moving toward digital, India is very well placed to take advantage of that. And while the IT sector has got impacted recently because of a concern about global growth slowdown, but we think that the structural growth for that sector looks fairly good and as a good opportunity over there. So, and obviously consumption, I think in India, especially the whole discretionary consumption, I agree there is a current slowdown which is there, but structurally I think India, with its per capita income now crossing $2,500, and we expect the discretionary consumption as a percentage of total consumption base to grow up, and that can be a good long-term play where you will see good companies, good brands getting share again from the unorganized sector and seeing a good growth over the next decade or so. So these are some of the themes which we think will stand out, not necessarily from a 1 year perspective, but slightly over a medium-term perspective.
That's quite positive. That sounds quite positive. A quick perspective on something that's very topical on Indian equities. One is the stretched valuations relative to peers. And the second is the foreign investor flows that have been quite weak in the past 12 months. What's your view on that? How do you see that panning out, and how do you see that impacting Indian equities from a short-term perspective?
So, I mean, last year we saw large outflows. Again, that was nothing specific to India, but globally we had seen outflows from emerging market funds. And India markets, however, did relatively much better in terms of the price performance because of the strong domestic inflows which were there. And as a result, India's premium, right, to the other, if you look at emerging market as a basket, then that had gone up significantly for the long-term average. And as a result, we've seen that in the last couple of months, especially last 3 months, there has been a trade where foreigners found the other emerging markets, especially China and Korea, Taiwan, which had significantly more attractive, and there was some money chasing that trade. And we've seen that our in the last month or so, year till date, have been a bit negative. And some of these other markets are now outperformed significantly. They're up almost like 25-30% or even more. So now I think the relative premium which India has little underperformed in the last 2 months. So that has now narrowed down, and it is now still slightly above the long-term average. So now I think structurally, if you look at foreign investors would still like to play the India story. That's where they see the long-term growth. In all the other markets, including China, while they will benefit from the opening up after the lockdown, it's not likely to be sustainable beyond the next 6 to 9 months. So I would expect that domestic foreign flows will start to again, once the China, whatever, the open up trade plays out, will start to move into India. And overall also we believe that flows into emerging markets in the next few years, should improve, because as dollar weakens, and also the growth differential between emerging markets and developed markets, especially whether it is US and Europe, will favor the emerging markets. So, and emerging markets had seen a long period of underperformance for the last decade or so. So we see a reversal of that and more flows coming into emerging markets over the next few years. And India share now of the emerging market flows, if you look at MSCI, it has increased significantly in the last 4 years. It's almost doubled to around 16%. So India should also get a fair share of those flows. And the ownership of foreigners or the overweight on India has also come down, right? Foreigners used to be, compared to the benchmark weight, they used to be overweight around 3 to 4%. That's come down to now less than 1%. So I don't think that going down much lower than that. So you should see this year a fairly good market, in terms of foreign flows, and domestic flows, I think, should sustain. I think we don't see any big increase there because, as I said, some asset allocation shift will happen towards debt. But the SIP book is still fairly strong, and that a lot of money is coming through that route, which is more long term. I don't see that really abating. And also the steady money coming in from the EPFO and the pension fund, right, where they're mandatorily allocating 15% incremental inflows into equities. That gives you almost a steady stream of around 14,000 plus another 3,000-4,000, so around 17,000 of kind of monthly inflows, which will be fairly sticky. So I think on the overall flows, I think that should be much better, at least on the foreign side, than what we saw last year. And that will actually keep the market slightly more. You won't see the market, while one would like to see the market more attractive or cheaper than this, right? But because of that flow, I think the valuations don't go down materially below the long-term average, right? Normally during a period of slowdown or when there are concerns, we see that undershooting significantly below the long-term average.
Well, just to round this conversation up, what are the risks that you are watching out for 2023?
So the risk would come in, I think, again, global, is where, factors, could be areas where you could see the risk coming in. It could either be coming in because interest rates continue to remain higher, or probably go higher. I think while recently the expectation of the Fed rate increase has again gone up a bit because US economy is still tight. But I think any geopolitical risk, I think, would be a risk which, like what we saw last year, right? Russia-Ukraine crisis actually destabilized the market, commodity prices went up. Any of that risks, I think, can be something which can hurt the market and probably further impact the slowdown what one is likely to witness this year. Apart from that, I would say that on the domestic front, I'm not really seeing any kind of major risk. I think things are pretty much under control over here. And on the oil, probably if oil prices shoot up above $100, because oil market is still fairly tight. And if that happens, then that could put some pressure on the current account deficit. We have seen some reserves, forex reserves, which were there, have got depleted a bit in the last 6 months. And if oil shoots up, then you would see further pressure on that, and that could put pressure on the currency, and in turn, in terms of capital flows and the broader market. So I think those would be the risks really to watch out for.
Thanks, Mahesh. Thanks for taking time out and joining our podcast. It was lovely having you with us.
Yeah, thank you. It was a pleasure participating, and I wish all the best to both of you.
Thank you, everyone, for listening. If you enjoyed the podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.